Economists are only expecting a moderate decline in South Africa's consumer price inflation. Stats SA will release the latest CPI figures today amid the ongoing financial turmoil. The expectation for the month of February is a decline to 6.8%. That's from the 6.9% recorded in January. For more on this, we are joined by FNB Economist Koketso Mano. Thank you so much, as always, for giving us your time. Koketso, what's the market expecting this time around?
Thanks for having me. So at FNB, we're expecting around 7% for this outcome. Consensus should be between that number and 6.9% around. So it does seem as though either inflation would be flat from what we saw in January, but there are expectations that there should be just a slight lift, taking into account some of the infrequent survey outcomes that SSA would be conducting in February, and those include, your medical insurance. So those numbers are big, and they're meant to come in the February survey and should lift some of that pressure on core inflation. At the same time, we're expecting to see food inflation remaining rather elevated. The load shedding crisis does not assist us here. We're also expecting to see some pressure on the manufacturing end of the core goods items. So it seems as though there's still a bit of pressure in the system, but particularly for this outcome, we're expecting to see a bit of pressure on the services side as well.
Koketso, an expectation of 7% is slightly going back to the marginal drops that we've seen in 2 consecutive months of CPI and the data readings. What then is to be said about it not fitting firmly within what the South African Reserve Bank is expecting, as we have been seeing those little drops in inflation activity, and it has been bringing in a little bit of optimism, but going backwards to 7% due to the economic activity currently would be a bit of a dismay.
Yeah, one part is that it could have been expected. What we have been telling, the story that we have been telling since lockdown is that post-lockdown you would see this very strong surge, or during lockdown you would have seen this very strong surge of goods inflation, as these supply-demand imbalances came into play. But we did mention that, once that starts to settle and economies start to open and, mobility improves, then you would see some of those services start to also lift as, activity normalizes. But also, the initial shocks that we had from fuel inflation, from food inflation, are also now starting to pass through to the entire basket. And that's some of the dynamics that we're seeing right now in services inflation. The lift in services inflation has actually been rather, gradual, not as quick as one may have expected. You saw it initially in items such as restaurants and hotels. You'd have seen it quite quickly in public transportation. Some of those shocks coming through quite quickly there. But now we're expecting it to continue to spread over the rest of the basket. And as I've mentioned, the big item coming out today is medical insurance. We know that gets surveyed around once or twice a year. That frequency has increased since lockdown. But the point here is we are starting to see a lot of those companies coming back to what we would more normally see pre-lockdown. We're not quite there yet. We're used to seeing numbers around 9%. A lot of these medical insurances, when you look at the averages, it's seeming right like between 7.5 and 8%. So we're not quite back to pre-pandemic normals. But it's seeming though that these services items are also starting to lift in line with the normalization in the rest of CPI. So I think the central bank will take this into account. What is important is what happens throughout the rest of the year, and we continue to see inflation moderating. It may be more gradual because of the pressure that we're seeing in food inflation, but we still continue to see that moderation coming through for the remainder of the year. And as we had in 2022, the average headline inflation number was 6.9%. We're now expecting that to fall to around 5.9%, so a full percentage point. Once again, what you said is correct. It's not where the central bank would like to have it. So still not really providing that comfort that I think the NPC would like to see when it comes to inflation falling back to the midpoint, but we're moving in the right direction in general.
Moving in the right direction, and I'm interested in finding out, given that forecast, then how should the central bank be responding? It's a brand new year. It is the second MPC of 2023, and we are noting the global developments. In the US, we're expecting their latest decision on rates, and then on the 30th in South Africa, we are expecting the central bank governor, Lesotho Kganyago, to give us their outcomes of the MPC meeting. Where should we be looking in that regard?
Yeah, so I think when it comes to the MPC meeting, one will be what's happening globally, as you rightly mentioned. I mean, the turmoil that's currently taking place in global markets regarding the banking crisis, what has been characterized as a banking crisis in the US, is very important, whether the Fed holds today or continues to hike. The communication in that regard will be very important, because on the one hand, you're trying to ensure financial stability, increasing liquidity in markets, but at the same time, you're also trying to fight this inflation issue. So it will be a monetary versus macroprudential issue coming through, or dilemma coming through in today's meeting. So that will be interesting to see how they communicate around that. But when it comes to SA, one will be what the US, the ECB, and them are still doing, which is generally still a hawkish tone on the monetary policy front. But on the other hand, they need to think about what's happening locally, right? So inflation is still above where they would like it to be, as was mentioned in the previous discussion. But also at the same time, you do have these very strong growth concerns, and how they could characterize that around load shedding versus where the potential of the economy is in the first place will be very important as well. Where we see what we see them doing at the end of March is to increase by another 25 basis points. But we strongly believe that this will likely be the last hike in this current cycle, and that is as per consensus as well. But the MPC did mention that they will remain data dependent, so how inflation progresses from here on forth is going to be very important for them. And one last thing to mention, I mean, on the 16th, we got the latest data from the BER inflation expectation survey, where we saw, inflation expectations are still trickling up. They're still edging higher, moving away from that 4.5% anchor mark. So this is one more thing that will give a bit of discomfort to the MPC.
Always a tricky balance for central banks. Thank you for your contribution. FNB Economist Koketso Mano talking to us in that preview ahead of the latest consumer price inflation figures to be released by Stats SA later today.